Mortgage rates ticked up again, and if you're thinking about buying or refinancing, this news could impact your decision. The 30-year fixed rate jumped from 6.53% to 6.64% this week, and that's not the only surprise the market has in store. So, should you lock in now, or is there still hope that the rates will go down? Let's break down what's going on. This week's rate movement have caught the attention of both buyers and sellers, especially after a significant jump in the prior week. After rates significantly jumped around October the 4th, many anticipated that the rise would moderate or even cool down. The market was hoping for some relief as economic conditions seemed to suggest a potential leveling off. However, Friday we saw that the average 30-year fix jumped to 6.64%, defying these expectations and keeping rates at highest levels since August. Let's talk about why this happened. A big reason is the 10-year yield, which is closely tied to mortgage rates. And the 10-year yield rose to 4.105%, marking its 8th consecutive day of increases. When yield goes up, mortgage rates tend to follow, and that's exactly what we have been seeing. But that's not the only factor at play here. We are also seeing mixed signals in the economy. On Thursday morning, the monthly core CPI reading came in at 0.3%, which was slightly higher than expected of 0.2%. This raised concerns that the inflation might be sticking around longer than anticipated. Immediately after the yield popped higher as investors reacted to the potential for more inflationary pressure, but right after that, jobless claims data came in much higher than expected at 258,000 versus the forecast of 230,000, throwing a wrench into the inflation fears. While there are still some details to be sorted out about the jobless claims number, it was enough to create indecision in the market, preventing a full-blown sell-off in the bonds. Now, here's where it gets tricky. Mortgage demand is actually down, with applications falling by 5.1% last week. Refinances dropped even more, down by 9% as homeowners face higher rates than before. But despite these declines, there's still a chance that rates could stabilize. So you might be wondering, why did rates jump so quickly? It comes down to investor reaction. Some economic data, like the jobs report, pushes investors to pull money out of bonds, causing bond prices to fall and yields to rise. And since mortgage rates are closely tied to bond yields, they climb too. Another reason is how lenders adjust their rates. Mortgage-backed securities often move in rate buckets. When rates cross certain thresholds, lenders reprice quickly, which is why we saw a sharp jump the previous week. So what's next? Before we get to the important economic data later in the week, keep in mind that the bond market will be closed on Monday, October the 14th for Columbus Day. This means we won't see any significant movements until Tuesday when the market reopens. Once the market is back, here's what we need to watch. On Tuesday, the Empire State Manufacturing Survey will give us a look at business conditions. And on Thursday, a big one, retail sales data. Strongest sales could mean more upward pressure on rates. We'll also get jobless claims and industrial production, which will show us how the economy is holding up. In general, we'll need some big ticket data to show clear signs of economic weakness in order to recover any decent amount of what was recently lost in the bond market. You might ask why? Because bad news for the economy often forces the Federal Reserve to consider bigger rate cuts, which can help push mortgage rates down. To that end, we are waiting all the way until Thursday morning for the next round of relevant reports. If the data continues to show a strong economy, then rates could keep rising. But if we see any signs of economy slowing down, it could finally give mortgage rates a chance to level off or even drop. So, if you are in the market for a home or thinking about refinancing, this is a critical moment. With rates now at 6.64%, locking in might feel like the right move, especially if you are worried about future increases. But if you think that rates might drop again, there could be still an opportunity later in the month. Right now, it's all about timing and staying informed. Rates aren't moving in a straight line, and we have seen this week they can change fast. So keep an eye on the economic reports coming up, and they could be the key to the next big shift. Looking ahead, next week economic reports could make or break this trend. We'll be watching closely to see if rates stabilize or continue to rise. Either way, I'll keep you updated so you make the best decision for your mortgage. Be sure to like, subscribe, and hit the notification bell so you don't miss out any updates. Stay tuned for more insights on how the upcoming economic data could impact your mortgage plans. Drop me a comment below. Do you think rates will continue climbing? Or are we about to see a drop? Let me know your thoughts. Thanks for watching.